Important disclaimer. All content in this deep research report is intended for informational purposes only. Nothing in the following report should be construed as legal, medical, financial, or official advice. This is a news analysis and discussion, not specific guidance or recommendations. News is news. The anecdotal stories and commentary below should not be treated as professional advice. Always consult qualified experts or trusted sources for any important decision-making. Finance and banking in 2026. 10 market-shaking trends tilting the global financial universe. In our top story, U.S. financial markets are wrestling with the fallout of another surprisingly robust jobs report and its implications for interest rates. The American labor market added about 172,000 jobs in May, comfortably outpacing forecasts and marking a resilient economy despite headwinds. The unemployment rate stayed relatively steady at 4.3%, signaling that companies are continuing to hire even as the Federal Reserve walks a tightrope between fostering growth and taming inflation. Strong hiring, coupled with upward revisions to prior months, has all but dashed hopes for near-term interest rate cuts, reinforcing the view that the Federal Reserve under new Chair Kevin Warsh will maintain a high interest rate stance to combat lingering price pressures. With inflation recently hitting 3.8%, its highest in 3 years due in part to surging fuel costs, policymakers are under intensifying pressure to keep monetary policy tight, an approach amplified by global uncertainties, such as an ongoing conflict in the Middle East that has sent oil prices soaring. CNBC News. Wall Street's reaction to the economic crosscurrents has been volatile, illustrating the tug-of-war between strong economic fundamentals and rising interest rate fears. Investors initially cheered the economy's momentum, propelling stock indices to multi-month highs after a remarkable 9-week rally for the S&P 500, its longest winning streak in years. However, that optimism swiftly gave way to risk-off sentiment as traders absorbed the good news is bad news dynamic where solid growth could provoke more tightening. Major indexes slid sharply after the employment data, with the tech-heavy Nasdaq down nearly 3 to 4% in its worst plunge since April 2025, as traders braced for higher-for-longer interest rates. Meanwhile, the benchmark 10-year U.S. Treasury yield spiked toward 4.5%, reflecting markets swiftly repricing expectations for continued Federal Reserve hawkishness. The result was a broad equity retreat that erased some of the stock market's recent euphoria, highlighting investors' jitters about how far the Fed might go to curb inflation. Amid these swings, economic policymakers face a delicate balancing act. Fed Chair Kevin Warsh, newly installed after a leadership transition, faces a stern first test of his tenure, navigating an economy buffeted by inflationary pressures, war-driven energy shocks, and a still strong job market. His colleagues at the Fed have voiced varying viewpoints. Some caution that counting on new technologies like AI to quell inflation is risky, warning that further rate hikes may still be needed. Others counter that the Fed must avoid overreacting to what could be temporary spikes from energy supply disruptions. The Federal Reserve's next policy decision will arrive in mid-June, with officials signaling vigilance and a bias toward keeping rates elevated or even hiking further later this year, unless and until they see clear evidence that inflation is moving back down to target. Markets now recognize the Fed's resolve, understanding that the interplay between economic strength and anti-inflation policy will remain a central drama for investors throughout 2026. CNBC +1. CNBC. Subtopic: Tech stocks tumble on rate jitters and chip sell-off. 7 sentences. The technology sector led the recent market reversal, as investors rushed to unload high-flying tech shares in anticipation of higher interest rates and a cooling of peak enthusiasm. The Nasdaq Composite slumped nearly 4% in one day, its steepest drop in more than a year, amid a sharp sell-off in semiconductor and AI-related stocks, showing how exposed the market had become to an overheated tech rally. Chip makers were hit especially hard. A disappointing earnings outlook from Broadcom, a key supplier of AI chips, triggered a global rout, wiping out a staggering $300 billion in its market value and sparking heavy selling across the industry. In South Korea, the Kospi Index, which had soared 105% year-to-date on an AI memory boom, plunged over 5% intraday on June 5th before pairing losses, with Samsung Electronics down more than 6% and SK Hynix nearly 10% lower. Investors appeared to be rapidly reevaluating sky-high valuations in select tech names, as even stellar results now risk disappointing those with outsized expectations. For now, many strategists view this as a healthy correction, a temporary shakeout rather than the end of the technology uptrend, as AI demand and digital infrastructure investment remain robust over the long term. Indeed, major asset managers still project strong semiconductor earnings and believe broader indexes can yet reach new highs once valuations recalibrate. While short-term volatility may remain elevated, the tech sector's innovative underpinnings, from AI to cloud computing, are expected to keep propelling growth in the years ahead, albeit perhaps on a more sustainable trajectory after this period of profit-taking. Let's detachins.
JSTMC.
Plus one. It's not just domestic markets making waves. Massive IPOs are reshaping the financial landscape and heralding a new era of tech-driven finance. 2026 is shaping up to be the year of the mega IPO, with several of the world's most valuable private companies, in sectors from artificial intelligence to space travel, preparing to go public. In an unprecedented development, SpaceX, Elon Musk's pioneering aerospace firm, confidentially filed for an IPO targeting a valuation in the $1.5 to $2 trillion range, seeking to raise an astronomical $75 billion or more in what would be the largest stock offering in history. Not far behind is OpenAI, the world-leading AI research company, reportedly generating $25 billion in annual revenue and eyeing a $1 trillion potential listing in late 2026 or 2027. Meanwhile, other unicorns like AI lab Anthropic, which has seen revenue explode by 14-fold in the past year to $30 billion, as well as enterprise software firm Databricks, digital payments giant Stripe, and cybersecurity innovator CrowdStrike are all in the IPO pipeline at enormous valuations. A Funding Tracker. Plus one. This IPO gold rush reflects a broader market appetite for innovation and growth, but it also raises questions about the capacity of markets to absorb such colossal offerings all at once. Analysts note that if these mega-cap IPOs, with combined targeted valuations of several trillion dollars, proceed as planned, they could reshape stock market indices like the S&P 500 and NASDAQ 100 by adding entirely new heavyweights in one fell swoop. The tech fervor driving these listings is reminiscent of the late 1990s dot-com boom, and some market veterans caution that concentrated hype can lead to volatility if expectations overshoot reality. Still, they argue the current crop of companies is different. SpaceX, OpenAI, and others have substantial revenues or tangible technological achievements, making them far more mature than the speculative startups of past eras. The coming wave of offerings is expected to attract massive global investor interest, from large institutions to everyday traders hoping to get a piece of the next tech giants.
JSTMC.
Plus one. A Funding Tracker. Plus one. As markets adjust for this influx of new listing giants, existing sectors and even alternative assets are feeling the impact. Cryptocurrency markets, for example, have seen capital rotate out as investors chase the glitter of AI and space-related plays, a trend epitomized by declining Bitcoin prices that we explore in the next section. Some observers note that traditional assets could face selling pressure as investors make room in their portfolios and as benchmarks evolve to accommodate these out-of-this-world debutantes. Regulators, meanwhile, are watching closely, aware that ensuring orderly markets during these historically large IPOs will be crucial. If successfully executed, the mega listings of 2026 could fuel broader market liquidity and innovation, a boon for economic growth, but any missteps could jolt market stability. Many are now eyeing the upcoming SpaceX IPO roadshow in June as a pivotal moment, A smooth debut by SpaceX would set the stage for the rest of 2020 SIX's IPO class, whereas any stumble might spook markets and prompt delays across the pipeline. Wall Street is essentially holding its breath as the new space age of investing prepares for launch on the stock exchange. Global Banking GANFINS. +1. Subtopic: SpaceX's stellar debut transforms market. 7 sentences. Investors around the world are eagerly awaiting SpaceX's stock market debut, which is expected to break every record and cement the company's status as a cornerstone of modern markets. The pioneering firm, which has revolutionized space transportation with reusable rockets, has lined up a 21-bank syndicate and aims to be trading on the Nasdaq later this year. If successful, SpaceX's initial public offering could instantly rank among the world's most valuable companies, symbolizing how the final frontier of space is becoming an integral part of the global economy. A SpaceX listing will have tangible ripple effects. Nasdaq has implemented a fast-track rule to add the company to the Nasdaq 100 index within 15 days if its market cap ranks among the top 40, a likely scenario, meaning many index funds will soon automatically become shareholders. Beyond raising capital, SpaceX's debut is galvanizing excitement about the broader space industry, from satellite communications to space tourism, and validating that space stocks have moved from niche to mainstream in investor portfolios. The company's ambitious goal to enable interplanetary civilization and human missions to Mars lends a futuristic aura that has captured public imagination and attracted massive retail interest, with a large portion of the IPO shares reportedly reserved for ordinary investors. Market analysts say SpaceX's performance will set the tone for other large upcoming technology IPOs and may draw even more capital into next-generation industries, effectively connecting the fate of our stock markets with humanity's journey to the stars. A Finding Tracker. +1. Space Nexus. The relentless forces of technological change and risk appetite are also reshaping the once high-flying world of cryptocurrencies, as digital coin markets experience a reality check amidst the rise of AI and mega-cap tech. In 2026, Bitcoin, the flagship cryptocurrency, is enduring its steepest year-to-date loss in over a decade, having plunged by roughly one-third since January to around $63,000 as of early June. This represents a dramatic reversal of fortunes. Just months ago, Bitcoin was basking in record highs above $125,000 in late 2025. But it has since tumbled nearly 50% from that peak as investors reallocate capital towards booming AI stocks and towering new stock listings. Even prominent institutional backers have pared back. For example, MicroStrategy, now Strategy Incorporated, one of Bitcoin's biggest corporate holders, sold Bitcoin for the first time since 2022. A symbolic move to manage liquidity needs even as it maintains overall faith in the cryptocurrency's future. The stampede away from crypto is underscored by record fund flows. Investors have yanked more than $3 billion from major Bitcoin ETFs in 2026, including a massive $2.7 billion outflow in just 1 week, the fastest on record. With the luster of crypto fading, its once robust correlation with stocks has not just weakened, but turned sharply negative, as the AI-driven equity bull run roars on while digital assets lag. Global Banking GANFINS. +1. Global Banking GANFINS. The shellacking in crypto markets comes amid a broader maturing and reordering of the digital asset ecosystem. Bitcoin's dominance in the total crypto market has slipped as large rival coins and stablecoins gain ground, reflecting a more diversified, utility-driven landscape where decentralized finance, DeFi, and tokenized assets are expanding. Paradoxically, some of Bitcoin's struggles stem from the very success many enthusiasts long sought. Big institutions are now deeply involved, and crypto products like futures and ETFs have tethered Bitcoin's behavior more closely to mainstream finance, draining some of its appeal as a non-correlated asset. Meanwhile, mining companies, faced with profit squeezes and high energy costs, are pivoting to AI computing for survival, repurposing their data centers to provide machine learning and cloud services. Industry veterans express mixed feelings. Bitcoin's dream as digital gold persists, but it's clear that the speculative frenzy has cooled. With more regulatory scrutiny and competition from central bank digital currencies, crypto players are being forced to adapt and innovate, even as some continue to position these assets as a long-term diversification tool in portfolios. Global banking GANFINs. Even so, within the crypto gloom there are glimmers of potential hope. Some market observers believe that the dramatic retrenchment could set the stage for a healthier, more sustainable trajectory for digital assets going forward. As weaker hands capitulate, long-term believers and institutional players with deep pockets are quietly accumulating Bitcoin and Ethereum at reduced prices, speculating on future rebounds. Standard Chartered analysts recently suggested that the crisis of confidence in crypto might be near its nadir, arguing that historically, steep Bitcoin corrections often precede a durable bottom and a new upswing in subsequent years. Moreover, the technological and financial innovation unleashed by crypto, from new payment systems to programmable money, continues to captivate policymakers and entrepreneurs even amid the market slump. While 2026 may be remembered as a sobering year for cryptocurrencies, many industry veterans remain optimistic that once the AI craze normalizes, blockchain and digital assets could reassert themselves in a more mature form, contributing to a diverse, tech-forward global financial system. Global banking GANFINs. +1. Subtopic: Crypto's Resilience and Road Ahead. 7 sentences. In spite of market pain, crypto proponents insist the long-term story remains intact. They point to the growing integration of digital assets into mainstream finance, from big banks exploring blockchain for settlement to nation-states embracing Bitcoin, as evidence that the foundation for a crypto-fueled future is still being built. Major investment houses and traditional exchanges have launched crypto custody services and Bitcoin funds, signaling that this asset class is here to stay. Some view the current drawdown as a purge of speculative excess that could pave the way for more meaningful innovation and regulation, much as the dot-com bust of 2000 eventually led to the stable growth of the internet economy. Crypto mining firms are reinventing themselves by shifting underused computing capacity into AI processing, finding synergy between blockchain infrastructure and machine learning demand. Regulators worldwide are also becoming more engaged, slowly crafting rules for stablecoins and crypto exchanges aimed at improving transparency and safety, potentially inviting back cautious investors over time. Even Bitcoin's protocol is evolving. Developers are trialing upgrades for efficiency and exploring new features like smart contracts, part of keeping the decade-old network relevant in the face of rapid tech advances. Shifting to monetary currents in the global currency markets, the Japanese yen has been drawing intense scrutiny after a dramatic slide to multi-decade lows against the US dollar. The yen's weakness, which worsened in late April to its weakest level since 2024, has become a pressing concern for Japanese policymakers due to the impact on import prices and household costs. Authorities in Tokyo have intervened forcefully. The government reportedly spent an unprecedented $74 billion in April alone to prop up the yen, a record monthly sum, after the currency breached key psychological thresholds. Those interventions sparked a sharp rebound at the time, but downward pressure soon resumed, largely due to the large interest rate gap between Japan's ultra-low rates and soaring U.S. yields. Japan's central bank has been reluctant to hike rates significantly, even as its global peers tightened policy, causing investors to borrow cheaply in yen and pour funds into higher-yielding markets abroad, a classic carry trade dynamic that further weighs on the yen. Bloomberg. The consequences of a weak yen have been two-sided for Japan's financial markets, pain at the consumer level, but surprising gains for some investors. On one hand, a soft currency drives up the cost of imported fuel and food, straining household budgets and complicating efforts to encourage domestic spending. On the other hand, Japan's stock market has been on a tear, as a cheap yen boosts the profits of Japan's exporters and entices foreign investors seeking bargains. In fact, the Nikkei 225 index recently surged to an all-time record high above 62,000 points, finally moving beyond a 1989 bubble-era peak after more than 3 decades. Japanese stocks have jumped over 30% so far this year as global funds warmed to a combination of robust earnings, corporate reforms, and favorable currency conditions. Market euphoria even led to the Nikkei's biggest single-day point gain in history this May, a 5.6% jump on optimism over a possible US-Iran breakthrough that spurred a risk-on buying frenzy. Capital Streets. +1. Yet Japanese officials know the current trajectory is unsustainable if the yen continues its slide unchecked. Prime Minister Fumio Kishida's government has pledged to support the yen with all available means, recognizing that a free-falling currency undermines public confidence and could eventually provoke a damaging surge in imported inflation. There are already signs of strain. Japan's inflation has climbed back near 3% as high import prices feed through, and wages are struggling to keep pace, factors that concern both officials and consumers. With global conditions still volatile, Japanese policymakers may be nearing a turning point. Some analysts speculate that if the yen keeps sinking, the Bank of Japan might finally adjust its ultra-easy stance, perhaps by raising interest rates or loosening its yield caps to stem the tide. For now, the world's third-largest economy offers a case study in managing the short-term boost a weak currency gives exports versus the burden it places on households, and how central banks weigh such trade-offs in an era of global economic uncertainty. Subtopic: Japan's stocks shine amid yen woes. 7 sentences. Despite the yen's travails, global investors are pouring into Japanese equities, capitalizing on the currency's decline and the country's historic stock rally. The Nikkei 225 just smashed through its 1989 record high of 38,900, closing above 62,800 in early May. This surge comes as Japanese companies reap windfall profits from a weaker yen, which supercharges exporters like Toyota, Sony, and Hitachi, making their goods more competitive globally and boosting repatriated earnings. For foreign investors, Japan's stocks are doubly appealing. Corporate reforms and improved governance have lifted earnings and shareholder returns, while yen depreciation means cheaper entry prices in dollar or euro terms. Overseas funds have been net buyers of Japanese shares for months, helping propel the Nikkei's multi-decade breakout run. The Bank of Japan's ultra-loose policy, a rarity in a world of rising rates, has kept liquidity ample, supporting asset prices even as the Fed and ECB tighten. Still, analysts caution that Japan's equity rally will need backing from stronger domestic demand and wage growth to keep going, making stable prices and a moderately stronger yen important for sustaining investor enthusiasm in the long run. Capital Streets. +1. No financial news roundup would be complete without covering the latest in global banking and regulatory actions, where accountability and compliance are taking center stage. In a major international scandal, HSBC's Swiss private banking unit has been formally charged by French prosecutors as part of a sweeping probe into allegations that it helped the former chief of Lebanon's central bank, Riyad Salameh, launder and siphon off hundreds of millions in public funds. The charges, which include organized money laundering and conspiracy to commit financial crimes, stem from an alleged $300 million embezzlement scheme tied to Lebanese public money in the 2000s. French authorities have reportedly ordered HSBC's local subsidiary to post €80 million in bail as part of the case, underscoring the gravity of the potential repercussions. Meanwhile, regulatory scrutiny isn't limited to Europe. In India, the central bank imposed fines on a major state-owned bank for KYC and account classification failures, underlining that emerging markets, too, are cracking down on lax compliance. And in the United States, bank regulators have issued warnings about banks' responsibilities to identify illicit activities, highlighting cross-border concerns such as potentially funneling funds connected to unauthorized labor practices. A reminder that banks can't turn a blind eye to illegal dealings in their client base. Bloomberg. +1. AML Intelligence. +1. AML Intelligence. India Times. For the global banking industry, this flurry of oversight measures signals an era of greater accountability and transparency. Financial institutions are pouring resources into compliance, investing in sophisticated AI-driven monitoring systems and bolstering their risk management teams, determined to avoid the fate of those entangled in scandals. The rationale is that stronger internal controls not only avert fines, but also rebuild public trust and investor confidence after years of reputational hits to bank brands. Encouragingly, shareholders have responded favorably to banks' improved compliance efforts, believing that cleaner operations mean greater stability and fewer nasty surprises down the line. Indeed, bank stocks have largely brushed off these regulatory headlines, indicating that investors welcome steps to fortify the system and prevent future crises. As one analyst put it, strict compliance is no longer a burden, it's a competitive advantage, implying that banks with a culture of integrity may gain favor with both customers and investors. The hope is that by learning from past missteps, financial institutions can refocus on their core mission, supporting the economy, rather than making headlines for misdeeds. Subtopic: Rebuilding Trust in Banking. 7 sentences. In the wake of scandals and fines, banks worldwide are doubling down on efforts to rebuild public trust and ensure rigorous compliance. Many have launched sweeping internal reviews to detect irregular transactions and adopted advanced AI-driven monitoring systems to flag suspicious activities in real time, strengthening their defenses against fraud and financial crime. Executives at major banks emphasize that a culture of integrity is paramount. They are expanding ethics training and tying compensation to sound risk management. There is also a push for greater international regulatory cooperation, as illicit money often crosses borders, a lesson underscored by global cases like the cross-continent HSBC investigation. Some industry leaders see a silver lining. They argue that banks with cleaner operations will ultimately attract more investment by reducing legal uncertainties and improving long-term stability. This approach aligns with a more people-centric vision of banking, where customers' interests and societal responsibilities are given equal weight to profits. Looking ahead, banks that embrace stringent compliance may emerge stronger and more trusted, while those that lag risk harsh consequences from both regulators and the market. Across the Atlantic in Europe, persistent inflation and energy shocks are testing the resolve of the European Central Bank, ECB, as policymakers prepare for yet another possible rate increase to tame price pressures. Eurozone inflation accelerated to 3.2% in May, up from 3% in April, and well above the ECB's 2% target, with surging energy and services costs driving the uptick. More troubling, underlying core inflation, which strips out volatile food and energy, also jumped to 2.5%, hinting that price gains are broad-based and sticky. These figures reinforce the case for a rate hike at the ECB's upcoming June meeting, as officials seek to prevent elevated prices from becoming entrenched. Financial markets have already priced in a 0.25% increase in the deposit rate and possibly additional hikes later in the year. The ECB's tightening campaign faces a precarious backdrop. Europe's economic growth has started to soften, and heavy industry is grappling with lingering energy costs and slackening global demand. Nonetheless, ECB President Christine Lagarde and colleagues have made clear that taming inflation is the priority for now, even amid signs that further rate increases could amplify risks to Europe's recovery.
Equal.
Europe's financial markets have thus far handled these headwinds with relative resilience. Major stock indices across the continent remain near multi-year highs, buoyed by robust corporate earnings in sectors like industrials and luxury goods, which have benefited from strong global demand. The euro has traded at moderate levels, aiding exporters by making European goods more competitive abroad, while European banks are healthier than in past cycles, helped by higher interest margins thanks to rising rates. Still, sentiment is fragile. Investors are closely watching data releases for any sign that tightening will overshoot, especially with economic growth already slow. Consumers face strains from higher prices, including elevated energy and food costs, and borrowing costs have jumped for mortgages and business loans, leading to concerns about household spending and corporate investment. As the ECB tiptoes through this minefield of inflation and growth trade-offs, it is increasingly relying on clear communication to avoid market shocks and maintain credibility. Market participants expect that once inflation shows definitive signs of cooling, the ECB could pause rate hikes, but until then, caution remains the watchword. The European economy's fate is thus hanging in the balance, but policymakers express confidence that price stability can be restored without derailing the recovery. They note that labor markets remain robust, with unemployment near record lows across the euro area, which should sustain consumer spending power. And government support measures, like energy subsidies and fiscal relief, are cushioning the impact of high prices on households and businesses in the short term. Moreover, elevated energy prices are already incentivizing faster investment in renewable energy and efficiency, potentially reducing Europe's vulnerability to future supply shocks. In the background, hints of diplomatic progress in global conflicts, such as the Middle East, could relieve upward pressure on oil prices, which would be a welcome relief in Europe, where fuel and gas costs have stoked inflation. There are also signs that inflation may soon peak as base effects from last year's energy surge fade, opening the door for the ECB to hit the brakes on tightening if warranted. For now, Europe is bracing for a summer of slower growth and continued vigilance on prices, hoping that by year-end the worst will be behind it and monetary policy can pivot from inflation fighting to supporting a renewed expansion.
Equal.
Subtopic: Europe's path forward, cautious optimism, 7 sentences, facing a complex web of challenges. Europe's economic outlook for 2026 is one of cautious optimism. Economic planners are encouraged by the resilience of certain sectors, such as manufacturing exports and a rebounding tourism industry, even as domestic demand has softened. Governments have been proactive. Many European nations are offsetting high energy costs with subsidies and accelerating investment in renewable energy and efficiency, a long-term strategy to tame future inflationary pressures. The labor market in Europe remains healthy, with unemployment near multi-year lows in key economies, providing a buffer for household spending. Additionally, the euro's moderate value is helping exporters and has attracted fresh foreign funds into European stocks, which still trade at relatively attractive valuations. By raising rates gradually and communicating clearly, the ECB aims to maintain control of inflation without choking off growth, walking a fine line between caution and support. Many economists expect European inflation to slowly ease in the second half of 2026 as energy markets stabilize, which could allow the central bank to pause or even begin trimming rates in 2027 if conditions permit. Geopolitical forces are still asserting themselves in financial markets, particularly via energy commodities and safe haven assets. In recent days, attention has fixated on the Middle East, where a major conflict with Iran that erupted earlier this year has been stirring turbulence in oil markets and fanning global inflation. The Strait of Hormuz, a vital artery for world oil supply, saw partial disruptions during the crisis, adding a premium to crude prices and sending fuel costs higher worldwide. The war-driven supply shock had propelled oil above $100 per barrel during the spring, with gasoline and diesel surging, diesel up over 50% since late February, analysts note, tightening consumer budgets across many countries. However, a possible diplomatic breakthrough with Iran has emerged, giving markets a dose of hope. Reports of back-channel talks and early terms of a potential agreement have immediately sent crude oil prices retreating from their highs, as traders anticipate improved supply conditions and a fading of war risk. This prospect of peace, though still uncertain, rippled across asset classes, fueling a rotation in equities. Energy stocks have cooled while other sectors regained ground as investors bet that falling energy costs will ease inflation pressures and boost growth. All eyes are now on the region's diplomatic efforts, which carry significant stakes for the global economy's trajectory in the months ahead. Gold Eagle. +1. MKNUS. +1. Commodity markets have been quick to react to changing war fortunes. Gold and silver prices soared to multi-year highs in recent weeks, with gold topping $4,500 per ounce for the first time ever, as investors flocked to safe havens during the height of geopolitical uncertainty. But as oil retreated on peace hopes, Treasury yields eased and precious metals trimmed gains, reflecting shifting expectations that global inflation might cool and central banks might not need to tighten as much. The Dow Jones Industrial Average even rallied nearly 900 points to a record-setting close above 51,500 just a day earlier, indicating renewed optimism that a resolution abroad could temper price pressures and allow stocks outside the tech sector to shine. Still, markets remain in a precarious mood, highly sensitive to the ebb and flow of diplomatic news. If talks falter, oil could spike anew, reigniting fears of stagflation. But if peace takes hold, it might mark a turning point where inflation decelerates, allowing economies to breathe easier and central bankers to shift towards stability rather than constant tightening. Gold Eagle. +1. Gold Eagle. A potential easing of war risks would be particularly welcome news for sectors and nations hammered by high energy costs. Airline and transportation stocks, which had been weighed down by expensive fuel, rebounded modestly on speculation of cheaper oil ahead. Meanwhile, the global push for alternative energy sources is expected to intensify as policymakers see once again the strategic value of diversifying away from volatile fossil fuel markets, a trend that could spur new investments in green energy technologies. Yet, the possibility of prolonged conflict still looms, and risk management is front of mind for many companies. Major oil consumers are exploring hedging strategies, and some governments are considering strategic petroleum reserve releases to cushion any further shocks. Amid these scenarios, one theme resonates. The interplay of geopolitics and markets remains as powerful as ever, a reminder that events in distant parts of the world can swiftly cascade into commodity prices and consumer costs back home. For investors and central bankers alike, vigilance and agility are key, as they seek to navigate a landscape where peace deals or escalations can make the difference between economic headwinds and tailwinds. Subtopic: Oil Markets End of Crisis. 7 sentences. In the oil markets, traders are warily optimistic that diplomatic efforts could pave the way for a lasting reduction in war-related premiums. The mere hint of a U.S.-Iran deal, potentially involving sanctions relief and de-escalation, has already taken some heat out of crude prices, which were recently near multi-year highs due to conflict disruptions. Analysts note that a formal agreement could allow up to 2 million barrels per day of Iranian crude back into global trade, easing the supply crunch that drove prices skyward. A drop in oil costs would not only relieve inflation pressure on energy-importing economies, but also free central banks from fears of an oil-driven price spiral, reducing the need for further interest rate hikes. However, energy experts caution that even if a peace deal emerges, rebuilding trust and infrastructure will take time, meaning oil prices could stay volatile in the near term. Nonetheless, the potential for calmer energy markets is a welcome sign for multiple industries like airlines and logistics that have been squeezed by high fuel costs. Overall, the chance of peace supports a hopeful narrative. If Middle East tensions abate, energy prices may retreat, giving the global economy a much-needed reprieve and policymakers room to shift from fighting inflation back to nurturing growth. Gold Eagle. +1. Returning to the technology sector, 2026 is proving a year of dizzying highs and swift reversals, especially in the realm of artificial intelligence stocks. Investor euphoria around AI, powered by breakthroughs in generative models and semiconductor advances, has driven a narrow set of mega-cap tech stocks to stratospheric valuations and record highs, fueling much of the stock market's earlier gains. But as noted, sky-high expectations have left little room for error. An air pocket in the AI rally emerged when Broadcom's weaker-than-hoped chip forecast raised concerns that even good news wasn't enough to sustain frenetic buying. That triggered a sharp correction, with losses spreading globally as investors reevaluated how sustainable the AI trade mania truly is. Yet the long-term fundamentals for tech remain compelling, and many believe this turbulence is part of the natural cycle of innovation that ultimately will deliver transformative gains. AI technology has become deeply embedded across industries, driving substantial productivity boosts and spawning new market opportunities even beyond the tech sector. Giant chip makers and cloud providers are investing tens of billions in data centers and next-gen semiconductor designs to support AI's explosive growth, indicating their confidence that the AI revolution is far from over.
JSTMC.
+1.
JSTMC.
+1. Indeed, the AI story is increasingly a global one, with Asia playing a starring role. South Korea's memory and chip titans were among the first to feel the sting of the recent correction. Their valuations had run up drastically, and modest disappointments sparked dramatic pullbacks. But asset managers now counsel diversification. The next phase of opportunity might lie in emerging markets where AI adoption is accelerating yet valuations are less stretched. Some strategists are urging investors to look beyond Silicon Valley to the likes of Taiwan and South Korea, which are producing the hardware and components at the heart of the AI boom. As AI spreads into autos, healthcare, education, and beyond, there is a sense that we are still only at the dawn of its economic impact. This means companies across global markets, not just the US mega caps, could benefit from the second wave of AI-driven investment, suggesting new winners may yet emerge beyond the usual suspects. The journey will likely remain volatile at times, but in the sweep of history, technological innovation continues to be a powerful engine of wealth creation and progress. CNBC. +1. Subtopic: Investors ride Asia's tech upswing. 7 sentences. Seeking promising frontiers, savvy investors are increasingly looking to Asia's tech resurgence as the next phase of market outperformance. South Korea's and Taiwan's stock indices, buoyed by their world-leading AI hardware and chip companies, have far outpaced Western markets this year. Investment strategists at major firms have recommended global investors expand exposure to emerging Asian markets to tap into this robust growth in AI-related industries. They argue that companies like TSMC, Samsung, and SK Hynix, all pivotal in supplying chips and memory for AI, still have significant upside since their valuations, while sharply higher in 2026, remain moderate compared to some U.S. counterparts. By mid-year, Taiwanese and Korean equity ETFs had soared roughly 67% and 109% respectively year-to-date, reflecting their outsized share of the AI-driven semiconductors powering the world's data centers and devices. This meteoric rise underscores the truly global reach of the AI revolution. Innovation knows no borders, and capital is flowing wherever the growth opportunities are. While geopolitical tensions, such as US-China frictions, could introduce risks, diversifying into Asia's tech markets is increasingly seen as a key strategy for investors aiming to ride the crest of the worldwide AI boom. CNBC. +1. Amid the upheavals and transformations of 2026, an undercurrent of resilience in the global economy is emerging, a testament to human adaptability and cautious optimism. Remarkably, despite war, inflation, and market volatility, the world economy has delivered stronger growth than many expected, prompting global institutions to bump up growth forecasts for 2026. The World Bank's January report highlighted that global GDP is now projected to expand around 2.6% this year, a slight improvement over last year's estimates and evidence of resilience in several major economies. Crucially, the United States, which accounts for a significant portion of the upward revision, has remained sturdier than anticipated, partly due to technological investments and consumer strength. However, not everyone has shared equally in the recovery. Fully 25% of developing countries remain poorer than they were pre-pandemic in 2019, underscoring the uneven nature of the rebound and the risk of global divergence. Policymakers, from central bankers to finance ministers, are urging reforms and investments to turn short-term resilience into sustained growth through improved productivity and better preparedness for future shocks. World Bank. +1. One bright spot is the wave of innovation and cooperation aimed at securing the future. Governments and businesses are doubling down on technology and human capital, investing heavily in AI, clean technology, and digital infrastructure while upskilling workers for the jobs of tomorrow. At recent forums, global leaders reaffirmed commitments to address climate change and vulnerabilities in supply chains, recognizing that such investments pay dividends in both economic sustainability and stability. Crucially, global inflation is projected to ease to around 2.6% in 2026, thanks to slower wage growth and lower energy costs, suggesting central banks may soon be able to step back from aggressive tightening. While risks like high debt and geopolitical tensions remain, the sense is that the world is adapting. Reconfigured supply networks, more prudent fiscal policies, and rapid technological advances are helping mitigate some of the threats that loomed large in recent years. Indeed, as we move through 2026, the narrative seems to be shifting from fear to a focus on building a future-proof global economy, leveraging the lessons learned from the tumultuous early 2020s to shape a more resilient, inclusive, and prosperous world. World Bank. +1. Now, the people-centric approach has become a mantra. Global organizations emphasize that true economic resilience hinges on empowering communities and individuals, from expanding healthcare and education to ensuring broad access to financial services. In regions with younger populations, creating jobs for millions of new entrants to the workforce has become an urgent priority, leading to massive pushes in education and digital skill building. Additionally, the crises have spurred unprecedented cooperation. Nations are pooling resources on issues like pandemic preparedness, climate finance, and infrastructure development, blending national agendas with global resilience goals. The strategic vision is that by addressing structural problems, inequality, climate change, inadequate healthcare, the global economy can achieve not just survival, but revival. Through initiatives like green transitions, fiscal reforms, and targeted investments in innovation and capacity building, leaders hope to turn resilience into a springboard for an era of renewed growth and human development. There is cautious optimism that the latter half of the 2020s could be defined by human ingenuity and cooperation, paving the way for improvements in living standards worldwide despite the formidable challenges of our time. Subtopic: Investing in a hopeful future. 7 sentences. Far from gloom and despair, a hopeful, futurist tone is taking hold among many global leaders and investors who see today's tribulations as catalysts for progress. The consensus is that accelerating innovation across domains like clean energy, artificial intelligence, biotechnology, and sustainable infrastructure is key to tackling global challenges while generating new industries and jobs. Governments and corporations are pouring resources into education, digital upskilling, and R&D, recognizing that human capital and technological breakthroughs are the strongest pillars of long-term growth. This human-centric strategy is supported by robust international cooperation on climate and health, as countries commit to new agreements and funding for shared priorities from reducing carbon emissions to preventing future pandemics. There is also growing optimism in frontier fields. Scientists, entrepreneurs, and venture capitalists are working together on space exploration, quantum computing, and advanced medicine, anticipating that new discoveries will unlock immense economic opportunity. Local communities and small businesses haven't been forgotten either. From rural broadband expansion to microfinance initiatives, efforts are underway to ensure that prosperity reaches people at all levels. Despite the obstacles, a narrative of determination and innovation is taking hold, hinting that the remainder of the 2020s could see hope and creativity triumph, propelling humanity toward a brighter economic future. Finally, looking beyond Earth's horizons, the space economy is rapidly becoming the next great investment frontier, a symbol of both our technological progress and our ambitions as a species. What was once the realm of science fiction is now a thriving $626 billion global industry as of 2025, spanning everything from satellite mega-constellations to private space stations. Commercial and government players are pouring capital into space ventures. In addition to SpaceX's anticipated IPO, Blue Origin and others are developing new heavy-lift rockets, while space agencies, like NASA, ESA, and their counterparts in China and India are inviting more private sector partnerships. New space infrastructure, such as thousands of broadband satellites, lunar landers, and planned orbital stations, is in the works, promising to expand connectivity on Earth and pave the way for permanent footprints beyond our planet. The situational awareness that space-based systems bring to everyday life, from navigation to climate monitoring, means that space tech is increasingly integral to the global economy's functioning. With launch costs plummeting, thanks to reusable rockets, entirely new business models are emerging: space tourism, asteroid mining prospects, and even in-orbit manufacturing are moving from science fiction to boardroom strategy sessions. Key developments, such as SpaceX's Starship becoming operational and NASA's Artemis moon program in full swing, have given credibility to visions of humanity as a multi-world species, illustrating that the border between Earth's economy and outer space is starting to blur. Space Nexus. Space Nexus. +1. Financial markets are starting to mirror this cosmic momentum, with space-themed ETFs gaining popularity and existing aerospace stocks climbing on the back of lucrative government contracts and investor excitement. Venture capital funding for space startups topped $10 billion in 2025, nearing record highs, as investors pivoted from the speculative phase of early SPACs to backing more established space companies with tangible revenue and technology. Key sectors attracting investment include satellite-based data analytics, turning orbital imagery into actionable intelligence, space-based national security, like monitoring and communication platforms for defense, and cutting-edge areas like on-orbit satellite servicing and space manufacturing. The involvement of multiple countries, from India's private rocket launches to the UAE's Mars missions, underscores the globalization of space. More than 70 nations now have active space programs, expanding the base for collaboration and competition alike. This competition is fostering innovation and cost reduction, further driving growth and broadening the viability of commercial space projects. While the space industry faces challenges, regulatory hurdles, technical risks, and the need to turn engineering feats into profitable business models, it's clear that space is no longer niche. It's increasingly a core piece of our future economy. Space Nexus. +1. Space Nexus. All the while, a futurist optimism propels the space sector, a faith that we are building the foundation of a trillion-dollar cosmic economy and potentially a multi-planetary civilization. NASA's Artemis program aims to return humans to the moon and establish a sustainable presence, which has spurred a wave of private sector initiatives around lunar landers, habitat modules, and resource extraction, like tapping water ice on the moon for fuel. Ambitious projects from both government and industry, including commercial space stations and Mars exploration plans, are galvanizing a new generation of engineers and entrepreneurs. They see a cosmic gold rush in the making, from mining asteroids for minerals to space-based solar power that could beam energy back to Earth in the future. Each successful mission, whether launching a satellite cluster or ferrying astronauts to orbit, adds credence to the idea that space is the next economic frontier. The benefits are not just in space, either. Space tech is delivering tangible improvements on Earth, from ubiquitous internet access via satellite to new materials and scientific breakthroughs born from microgravity research. And while the obstacles are still huge, distance, cost, human safety, the mood throughout the industry is resolutely hopeful. As humanity extends its reach beyond Earth, the potential for progress, discovery, and prosperity seems as limitless as the cosmos itself. Space Nexus. Subtopic: To the Moon, the New Space Gold Rush. 7 sentences. With the momentum of today's space industry, talk of human colonies on the moon or even Mars is no longer pure fantasy, but a serious target for planners and investors. Multiple countries and companies are already working on lunar bases, eyeing possibilities like mining moon ice for water and fuel and extracting rare metals that could be valuable back on Earth. This vision has given rise to a budding space mining sector, with firms designing robotic miners and pushing for clear rules on extraterrestrial resources, heralding what some dub a new gold rush beyond Earth. Investors, too, are on alert. Space-themed funds and venture capital are proliferating, and pre-IPO share trading of space companies is booming, as people look to stake an early claim in enterprises that may dominate orbital services or planetary industries. Today, a variety of space tech startups, from rocket builders to satellite networks, form a vibrant ecosystem, backed by deep-pocketed governments and private investors alike. Every successful rocket launch or space mission serves as a proof of concept for these ventures, bolstering confidence that space is indeed the next big economic frontier. And while technical and financial challenges abound, a profoundly optimistic ethos prevails. As we venture into the final frontier, the opportunities for invention, economic growth, and human advancement are beyond anything we've yet experienced. Video description. In this in-depth report, we explore 10 trending stories in finance and banking as of today, weaving together an analysis of current events and their futurist implications. From a surprisingly strong U.S. jobs report rattling markets and the Federal Reserve's interest rate stance, to an AI-driven stock rally hitting turbulence, to mega IPOs like SpaceX's looming debut, we examine how each development is shaping global markets. We delve into cryptocurrency's slump amid an AI investment craze, Japan's surging stocks and weak yen, global bank scandals prompting stricter compliance, and Europe's inflation fight. We cover Middle East diplomacy potentially shifting oil and gold prices, and highlight the resilience and hope emerging in the global economy. Finally, we take a giant leap into the space economy, discussing how it's becoming an integral part of our financial future. With a positivist, technologist tone, this report connects each topic to a human-centric, hopeful theme, from jobs growth fueling American optimism to space exploration inspiring humanity's next chapter in economic progress. Disclaimer: this report is for information only and is not financial or official advice. Video tags: finance